All right, let's talk JAKKS Pacific. Today, we are breaking down their latest earnings call, and wow, what a quarter. It was a story of huge contrasts, a really surprising win on the profit side, but a pretty painful miss on sales, all happening in a trading environment that management is now just calling the new normal.
So here's how we're going to tackle this. We'll start with the headline numbers, then we'll dig into this massive split in their global performance. After that, we'll look at their strategy for walking the tariff tightrope, analyze their much stronger balance sheet, and then finally, we'll give you our call on what's next for the company.
So first up, the earnings snapshot. And this Q2 report was a classic head-scratcher for investors. The bottom line told a story of real resilience, while the top line, well, it painted a picture of a pretty significant struggle.
And here's that paradox in black and white. On one hand, the company absolutely crushed earnings expectations. They posted a 3-cent adjusted profit when analysts were bracing for a 17-cent loss. I mean, that is a huge beat. But on the other hand, they missed on revenue, which came in at about $119 million, down almost 20% from last year.
So, how did the market react to this mixed bag? Well, it zeroed in on the negative. The stock dropped roughly 8% in after-hours trading, which is a pretty clear signal that the revenue miss and all the uncertainty that comes with it completely overshadowed that impressive earnings beat.
Now, to really understand that big revenue miss, you have to look at where the sales are actually coming from. And when you break it down by geography, it is truly a tale of two completely different companies.
And just look at this divide. It is staggering. Sales in the US absolutely cratered, down over 30%. And management pointed the finger directly at tariff uncertainty and just widespread caution from US retailers. Meanwhile, international sales just exploded, surging by nearly 41%, and that was driven by an incredible 65% growth in Europe in just the first half of the year.
And if we look at the product segments, both took a hit. But the costume business, man, it got particularly hammered. At one point, it was facing tariff hikes of up to 145%. That, you can imagine, led to a ton of order cancellations and basically put that part of the business on ice for a bit.
So this brings us to the most crucial point. How is management navigating this tariff storm? They are not just sitting around waiting for it to blow over. They've adopted a really practical, multi-pronged strategy to deal with what they now see as the new reality.
And this quote from CEO Stephen Berman says it all. You know, they're not just hoping tariffs disappear. They are treating this environment as the new normal and fundamentally retooling the business to operate and hopefully thrive within it.
Their response really boils down to three key things. First, they're diversifying manufacturing, moving away from being totally reliant on China. Second, they're investing in duplicate tooling for their best sellers, which gives them the flexibility to move production around to cheaper regions on the fly. And third, they're actually exploring US production, though they're pretty realistic that that's not a silver bullet.
Okay, let's switch gears and talk about the balance sheet. Because while sales were definitely weak, the company made some incredibly smart moves to strengthen its financial position. I mean, check this out. They more than doubled their cash position year over year, ending the quarter with a very healthy $43.1 million in the bank. This just shows their intense focus on liquidity, on building a fortress to ride out this storm.
And a major upgrade here was refinancing their debt. They got a new $70 million 5-year cash flow revolver. Now, this is a huge vote of confidence from their lender. It gets them away from a more restrictive, old-school loan and gives them way more flexibility to operate, which for a seasonal business like toys is absolutely critical.
And if you want to understand their entire philosophy right now, this quote from the CFO is it. They are prioritizing profit and cash above everything else. They're basically saying, we're willing to let sales slide a bit in the short term as long as we protect our bottom line and our balance sheet.
Okay, so let's put all these pieces together. What can we expect from JAKKS Pacific moving forward? What's our call? So looking ahead, you've got this real push and pull. On the one hand, they have a strong product pipeline with promising stuff like Sonic and new Disney lines. That's a definite catalyst. But those products are running headfirst into a wall of very cautious US retailers who are delaying their holiday plans, and that means less time on the shelf. So here's our prediction. We expect another quarter of tough US sales, but thanks to management's discipline, those profit margins should hold up pretty well. As for the stock, it's probably going to tread water, stuck in a range until we see clear signs of life in the US market or some really good news on the tariff front.
And for all those reasons, our final rating on JAKKS Pacific is market perform.
The company's excellent cost control, that impressive international growth, and their solid balance sheet are all great. But right now, they're being appropriately offset by the severe and unpredictable headwinds they're facing in their biggest and most important market.
Finally, a little wild but plausible idea for the options traders out there. It's basically a strategy that lets you own the stock to capture any potential upside, while building a safety net below a certain price. You do it by buying one option for protection and then selling another cheaper one to help pay for it. It's a structure that lets you bet on management's smart strategy while still hedging against those very real risks weighing on the stock.
And as always, please remember, this is not financial advice. Be sure to do your own research and due diligence before making any investment decisions.